How the Fed funds rate really affects your money. When you see headlines about the Federal Reserve cutting interest rates or raising interest rates, it sounds like everything in your financial life should change overnight. But the reality is much more complicated. The Fed funds rate is important, but it's not the same thing as your mortgage rate, as your credit card APR, or what your savings account pays you. All of these items are all connected, but they're all different. Today, what I want to do is I want to take some time to break this down, and I want to do it in plain English so you understand the relationships and all of the differences between each of these items. Part one of what I want to talk about today, what the Fed funds rate actually is. The Fed funds rate, it's the interest rate that banks charge each other for overnight loans. So the Fed funds rate is very short term, overnight. It's also a benchmark. The Federal Reserve sets a target range to guide the economy, higher to cool things down. Think back in 2022 when inflation surged and the Fed raised interest rates. That was to cool things down. The Fed will move that target range lower to help stimulate the economy. Again, think back to 2020 in March during the COVID-19 pandemic. The Fed slashed interest rates to help stimulate the economy. But we have to remember that the Fed funds rate is ultimately just a bank-to-bank rate. It is not an interest rate that you will pay directly. The second part of what I want to talk about today is mortgages. Mortgages, housing is the bedrock of the economy in our country. It's a major investment. It's a major loan. It's a major asset for people on their balance sheet. And mortgages are a long-term loan. They do not follow the Fed funds rate directly. Mortgages, they actually track the yield on the 10-year treasury. So that yield on the 10-year treasury, it's driven by inflation expectations, it's driven by economic growth, and it's also driven by demand for US government bonds. That's why you can see the Fed cut rates, but mortgages barely move or even tick higher. We can go back and look at October of 2024, September of 2024. When the Fed began lowering interest rates, mortgage rates started moving higher at the same time. So remember, mortgages live in the long end of the bond market, not the overnight Fed funds rate that the Federal Reserve controls. The third part of what I want to highlight today is credit cards. So credit cards are a different story. Most are tied to the prime rate, which does move directly with the Fed funds rate. So when the Fed cuts interest rates, your credit card APR, it does come down. But the catch, always the catch, especially with credit cards, is that when interest rates are already north of 20%, a quarter point barely makes a dent. The connection between credit card rates and the Fed funds rate is real, but the impact is relatively small. Part four of what I want to highlight today is auto loans. So auto loans sit somewhere in the middle. Banks, finance companies, those set the rates that are based partly on their cost of funds, which is what the Fed influences, but also, of course, on consumer credit risk and the automobile market itself. That means that auto loans don't always move in lockstep with the Fed. They'll respond to what the Fed is doing, but they're not going to move tick by tick together, which is very important to understand. Part five of what I want to highlight today is savings and CDs. This is where consumers, where you and me, feel the Fed more directly. When the Fed raises interest rates, banks tend to increase what they pay on your deposits and what they pay on CDs. When the Fed cuts rates, those yields come down. But of course, in a financialized world that we live in today, competition matters. Online banks and money markets, they may adjust more quickly than big traditional banks. Big traditional banks and the rates that they pay may lag a bit more. So again, the connection between all of these things is there, it's real, but it really does boil down to where you actually hold your money and where you hold your cash deposits. Part six of what I want to highlight today is the yield curve connection. All of these rates that I've highlighted today, borrowing costs, savings yields, they line up along what's called the yield curve. Short-term rates are anchored by the Federal Reserve. Long-term rates are set by the bond market. Again, long-term rates are influenced by inflation expectations, economic growth, and ultimately the appetite for US debt. Our government in the United States issues a lot of debt. There can be a large appetite or a small appetite for that debt. Mortgages live in the long end, credit cards live in the short end, auto loans sit somewhere in the middle, savings accounts, again, the interest that you're earning on your cash, those float closer to short-term moves. That's why the Fed's decisions about what they do with interest rates can ripple unevenly across your financial life. If you're in the position where you see your yield on your savings deposits decrease quickly after the Fed has cut interest rates, you are not, in all likelihood, going to see the opportunity to refinance your mortgage move in lockstep with what your savings is earning. Let's talk about what we should actually evaluate. Let's actually make this real, because the Federal Reserve, they just lowered rates by 1/4 of a point in September of 25. What is it that you, that me, that all of us should actually do with all of the information that I'm sharing with you today? So first off, let's talk about the credit cards. Your APR, it might dip slightly, but at 20% or higher, as far as your interest rate goes, that is still punishing debt. If you are carrying revolving balances, paying 20% or more on those, right now, this is the time to look at paying them down, or maybe even look at consolidating those at a lower fixed rate. Part two, mortgages. A Fed cut, again, doesn't guarantee lower mortgage rates, but if you bought a home in the last 3 years at a 6 or 7% interest rate or higher, maybe now is the time to check where refinancing options stand, at least run the numbers. This is a conversation that you should have with your financial planner to see if it makes sense. But recognize if you refinance a mortgage, there's costs involved. So it ultimately all needs to make sense. But if you've bought a home in the last few years, now is the time to evaluate it and to run those numbers. Number three, auto loans. Rates might ease on used cars, but sticker prices are ultimately the biggest factor. The same is still true for houses. The price that you pay is crucial. If you're in the market, negotiate the price first on a new vehicle, then you can evaluate financing. Four, your savings, your cash, expect deposit rates to slowly come down. Check your emergency fund, check your CDs, check your money market accounts. Make sure that the cash that you have is still earning a competitive yield, especially if your money is at a traditional bank, if your money is at a big bank. Number five, your portfolio. Interest rate cuts change how cash, how bonds or equities or stocks compete for your money. Don't leave too much money sitting idle in cash, and make sure your bonds are positioned for the road ahead, not positioned for the environment that we've been in the past. Let's boil all of this down. What is the bottom line here? The Fed funds rate, it's important, but it's not a magic lever that instantly lowers every cost or raises every yield. Mortgages follow the 10-year treasury, credit cards follow the prime rate, auto loans reflect both Fed policy and credit markets. It boils down to the individual. Savings accounts, what your cash is earning, it tracks what the Fed does, but it depends upon the bank. But now that we have seen a September rate cut in 2025, the real work for you is to review your own debt, review your own cash, review your own portfolio. Don't just watch the headlines. Use them as reminders to make sure that your money is working as hard as possible for you.